Welcome everyone on to this month's event on supporting employees tax efficiently. It's great to have everyone on with us this afternoon. If anyone has got any technical issues during the event, please feel free to contact us using the chat function. And we will be having a Q&A session towards the end of the event. So please do feel free to post your questions in the Q&A box as we go through, and we'll pick up your questions and address these later on in the event. My name is Carl Taylor, and also on the panel this afternoon, we've got Jack Bennett, who is a tax advisor from our tax team here at Oldfield. So this month's event is really all about supporting employees tax efficiently. We all know this is a pressing subject right now. And the fact is that employees are being impacted, like we all are, with the significant increases in inflation, particularly increases in energy costs. Although the recent announcements by the Prime Minister on energy support might reduce the impact of that to some degree. So you can see this graph on screen now illustrating the inflation trend over the past 30 months or so. And you can see the significant increase towards the end of the graph. You can see that pushing upwards. And then you can see the next line I've just added shows the average increase in regular pay for employees over the same period. And what you can quite clearly see is that the rate of pay growth hasn't actually kept up with inflation. And so we've actually had a period of real wage decreases for employees based on the Office for National Statistics figures here. Now, that will vary across industries and it will vary across public, private sector, but it gives an overall picture that by June 2022, employees on average were experiencing a 3% real pay cut. And added to that, there's the expectation of increases in interest rates on debt, and also the fact that earnings are obviously increasing while the tax thresholds have largely stayed the same, means that a record number of UK taxpayers are actually moving into the higher rate band where they're paying 40% tax. And that also means that there's a record number of taxpayers having their child benefit clawed back from them through the high income child benefit charge. So there's really quite a combination of pressures on employees. And that's really the real reason why we're here this afternoon. And we want to share some practical tips and strategies to support employees tax efficiently at this time. So in terms of the agenda, we just want to start by talking about how to structure current remuneration tax efficiently. So there'll be things that you're already doing, obviously paying a salary, doing company cars, those kind of things. And we want to just talk about how to structure those things in the most tax efficient way. And then we're going to go on and talk about additional perks for employees. So some of the additional things you could look at doing for employees to support them tax efficiently. Then we're going to talk about rewarding and retaining key employees. And then we're going to talk about, and then we're going to just wrap up with the key takeaways and a Q&A session right at the end. Obviously, the simple solution to all of this would be just to keep increasing pay through the payroll. But the fact is that does cost a significant amount of tax for the employer and particularly the employee. So I just put together a couple of examples here just to show the impact of an employee earning an additional £1,000 that goes through the payroll. So first example here, this is an employee that's a higher rate taxpayer. We pay them £1,000 extra through the payroll. They pay tax at the high rate on that. Employees NI. The total amount that actually ends up in the employee's hand is £568. So there's quite a significant chunk taken out there in tax and national insurance. That does get even worse in certain scenarios. So just look at the next example here. This is an employee who's earning between £50,000 and £60,000. And it's in that bracket where people's child benefit is clawed back. And so I've got an example here, just an employee's got 3 children and they're claiming child benefit for all those 3 children. we pay them an additional £1,000, and not only do they pay the income tax, the national insurance, but there's also the high income child benefit charge on that. They end up only taking home £305 out of that £1,000 bonus that you gave them. And then the next scenario is a employee that's actually on the boundary with, and paying them £1,000 is going to take them over 100,000 gross income, and that's when you start to lose the personal allowance. So you can see in this example, we pay the employee £1,000. They pay the income tax, national insurance, but then they also lose a part of their personal allowance, and that means there's an extra tax bill for them. So total that comes into their hand as an employee is £368. So some quite significant chunks there being taken out, and so, you know, while increasing pay through the payroll is inevitable, there are other strategies we can look at. So I'm going to hand over to Jack to talk about ways to structure current remuneration more tax efficiently. Thanks, Jack.
What you've gone through in really just setting out the tax cost of paying those bonuses and increasing pay. Now, before we look at additional ways of helping employees, I just wanted to step back and really have a look at what we're already doing and whether there's any better ways of doing it. So whether we can get better outcomes of what we're already doing. Now, the first point is probably one of the more obvious ways to increase the net pay that employees receive, and that's by looking at their vehicles, so their company cars. Now, I'm conscious that we've gone over this ground many times before in our webinars, but where you're providing your employees with a company car, and particularly if their car is coming up for renewal in the near future, just make sure you use this opportunity to move to a more tax efficient vehicle. So as we've covered previously, in order of tax efficiency, first you need to look at wholly electric cars. So will that work in this situation? It doesn't for all. Then if that doesn't work, have a look at commercial vehicles, so vans or pickups. Then if these don't suit, you can then perhaps have a look at plug-in hybrids, so plug-in hybrid cars, and then you might say as a last resort, look at your petrol and diesel. I'd also just stress that it's important you discuss the tax cost of the different options with your employees. We've seen it a number of times over the years where the employees just don't realise how much they're paying in tax each month on their vehicle. And so they don't really see the opportunities that they've got to save tax. Now, as with all tax, you've got to have a balanced approach, and a fully electric vehicle doesn't work for everyone, it doesn't work for every situation. But just to illustrate my point, and apologies for anyone on the call who's not particularly interested in cars, but just looking at an example of a Skoda Superb, which would be a fairly typical company car. So this particular model, you can get a diesel engine, and a 40% employee would pay £445 per month in tax. Now, if you just take that exact same vehicle, same make, same model, same style, same accessories, same added extras, and then just replace the engine with a plug-in hybrid engine, suddenly that employee will only pay £159 per month in tax. So for exactly the same car, just a different engine, they're suddenly going to increase their net pay by £286 per month. When you look at that in comparison to the rising energy prices, the rising interest rates, that goes a long way. And if you wanted to go further than that, you could even let them charge the vehicle up at work, for example, and they wouldn't pay any additional tax on that. So then you might say you're compounding the effect of it, you're allowing them to reduce their fuel bill as well. Now, when discussing cars, the other question that frequently comes up is in relation to salary sacrifice schemes. And just really initially, just stepping back and looking at what a salary sacrifice scheme is. In simple form, salary sacrifice is where an employee agrees to reduce their gross salary in return for non-cash benefit. So this used to be a lot more widely used. However, there were changes brought in April 2017 and then further changes in April 2021, which reduced the scope and availability of salary sacrifice to these three key areas: pension contributions, childcare, and low emission vehicles. So that's all quite theoretical. So how does it actually work? Well, if we look at an example, we've got an employee who wants to get a coupe reborn, you can see on the right, wholly electric car, but the company doesn't include this vehicle within their package. So on the left-hand side, we've got the first option, which in many cases is the default option. So he has his gross salary of £80,000. He'll pay tax and national insurance of just over £25,000, giving him a net income of £54,500. Out of that net income he receives, he'll then pay the cost of the lease, so £6,300 in this case, giving him remaining disposable funds of £48,219. Now, the other option that he could look at is through a salary sacrifice. So what would happen? So we take his gross salary of £80,000 and reduce it by the cost of the lease, so the £6,300, which is what the company will pay. So the company pays the lease and he agrees to reduce his salary to £73,700. He will incur a benefit in kind charge, but as it's an electric vehicle, it's fairly small, so £640 he'll be taxed on. So overall, he'll pay tax and national insurance of £23,012, giving him a net income of £50,688. But then the key point is, there's then no lease payments to take out of that as well, because these are being paid by the business in return for reducing his salary. So in these circumstances, the employee would save just under £2,500 per annum. Now, the savings would also significantly increase if the employee was earning in excess of £100,000. Going back to the point that Carl mentioned earlier, where it could potentially help them to regain some of that personal allowance they'll have lost. There's a few considerations to take into account, however, in setting up a salary sacrifice scheme. Firstly, it's got to be a contractual change. So the employee's contract has to change as part of this transaction. It's got to be a formal agreement, and it's got to be set up with a proper established scheme. And there are numerous companies around that can assist in putting this in place for you. And the other important consideration to take into account is the way that this could impact the employee's ability to get a mortgage, because they are reducing their gross salary, which the gross salary is often the basis used to calculate how much the employee can borrow. So by including salary sacrifice, you could risk minimizing the amount that they can borrow on their mortgage. So it's just one to be aware of. Moving on from vehicles, another opportunity would be to just step back and review the way that you're paying bonuses. And particularly I'm thinking of older employees that don't necessarily need the cash from the bonus here and now. So as an employer, you can make contributions into the employee's pension pot rather than paying them a bonus. And the benefit of doing this is that the employee doesn't incur any national insurance charge on that amount, where they would have done if this was paid as a bonus, and likewise for the employer. On the subject of pensions, there's also the option of increasing the amount you pay to any employees who pay into a pension scheme under auto-enrolment. So everyone will be aware of auto-enrolment and how it works, but basically the minimum contribution each month must be at least 8% of their qualifying earnings, and of which the employer must pay at least 3%. So just to give an example, help it come to life, we've got an employee earning £50,000. The top table really shows how it would, the default situation, how it really often works. The employer pays a 3% contribution on the qualifying earnings. So that's £109 per month the employer puts into the employee's pension fund. The employee then contributes the remaining balance, the 5%, £182 they put into their pension pot. So you've got total contributions each month of £291. The second table then just shows how it could look if the employer chose to increase their contribution percentage. So as an employer, you could increase your percentage from that 3% up to 6%, say. So the company would put £218 per month into that employee's pension pot. And what that does is it means that the employee has to contribute less each month. So they just contribute the 2%, £73. And you'll notice that the net impact of that is that the amount going into the pension pot each month is the same, still £291. So the employee has still got that building up. However, the amount that the employee is having to take out of their net pay to put into the pension pot has decreased by just over £100. So that's more money in their pocket at this point in time. Hope that helps to explain some ideas, Carl.
That's great. Thanks, Jack. So I'm going to sort of move on to look at some of the additional perks we can offer to employees to help support them in a tax efficient way. There's really four main ideas that I want to talk about. And the first one you can see on screen here now is an employee earning interest on a loan to the business. So you might have a situation where an employee is saving a lot. They're putting money aside in savings. And if your business is actually needing funding, then the employee could make a loan to the business and you could pay them interest on that loan. And being an unsecured loan, you could pay an interest rate that's higher than the kind of interest rate they would get just investing the money in a bank account. And that interest would be tax deductible for the business and would be a tax efficient income for the employee. There are some additional savings allowances and so on that often aren't actually fully utilised. And this could be a way for the employee to use those allowances. Obviously, the employee in question would need to be comfortable with actually loaning money to the business. They need to understand that there is a risk involved, and there would need to be a clear documented loan agreement written and signed. And if you're a company, you need to be aware that if a company pays interest to an individual, there are actually filings that have to be done with HMRC. But overall, it's actually quite a good option. You know, if the business is needing funding and an employee is actually putting money aside in savings where they can actually loan the money to the business, actually earn interest on that loan, and that would be a tax efficient income for them. The other way round, looking at the other way round, an employer or business can actually make a loan to an employee of up to £10,000, and that's tax-free. So this could be helpful to an employee. It could help an employee reduce high interest loans that they've got elsewhere. And it could be used as a retention incentive as well. The loan would obviously have to be repaid if an employee leaves. So just an example where this could be useful, say an employee had incurred a credit card debt of £10,000 and were racking up interest at a rate of, say, 20% per annum. If the company made a loan to the employee of £10,000, the employee could clear off the credit card debt and obviously save £2,000 of interest per annum. Again, we just point out it does need to be documented properly. You would need a written and signed loan agreement. And just to also flag up that you can't really do this very easily for directors or for family of directors, because you'd end up incurring Section 455 tax on that. But it would work well for normal employees. Third idea here we've got is trivial benefits, which I think many would be familiar with now. And this is a provision that means an employer can provide gifts worth up to £50 each, tax-free to employees. So there's a few conditions around it. It can't be cash, so you can't literally give them £50 of cash, but it can be vouchers. So it could be an Amazon voucher, it could be anything else, food or drink, charcoal for the barbecue, whatever. And that can be an effective tool to help support employees. It needs to be up to £50 per gift. It can't be more than £50 per gift. And it needs to be a genuine gift. It can't be related to performance. So it's not a bonus because we've hit sales target or anything like that. It's genuinely a gift for a birthday, an anniversary or something like that. So it's only a small thing. It is trivial benefit. It's only small, but it is a worthwhile tool to use. There's not strictly any limit to the number of times you can do it for employees, but there is a limit for directors and their family of £300 per tax year. Then fourthly, there are some other HMRC schemes that aren't very often talked about and they're not very well known. And that's a staff suggestion scheme, which allows you to reward employees tax efficiently if they come up with good ideas that will help make the business money or save the business money. And you can tax efficiently reward employees for doing that. And there's also long service awards, which allows you to reward long serving and loyal employees in a tax efficient way. There is quite a bit of detail around those two schemes, quite a bit of detailed rules, which I haven't necessarily got time to go into right now. But we have got an article on our website about it, which does set out the detail fairly clearly. So we'll make sure everyone's got a link to that article after this session ends on the follow-up email. So Jack is now going to talk to us more about rewarding and retaining key employees. Thanks, Jack.
Thanks, Gal. Some really valuable suggestions in what you've gone over there. Yeah, just for this final part, I just want to really focus in on the key employees in your business. Now, these are you might say the vital employees, the ones you don't want to lose, typically high earning part of the management of the business. And in the current time with the inflation the way it is, they may be struggling to maintain their normal standard of living. And as Carl went over at the beginning, any bonus paid to them, in reality, they don't get much of that in their pocket. It doesn't impact their cost of living very much. Most of it goes in tax. The solution for these employees could be to look at including them in the ownership of the company. And there's really three key reasons for considering bringing employees into ownership. Firstly, there's goal alignment. So there's been numerous studies that have proved that a share ownership has a significant impact on the goals and alignment of employees. The employees then have the same objective as the owner, both working together to make the business as valuable as possible. Secondly, there is also incentivization and retention. So as the business prospers, so does the employee. And then they have to stick with the business, they have to stay with you in order to realize that benefit. And then thirdly, there are some short-term and long-term tax efficiencies to be gained along the way. I would just issue a word of caution when discussing this subject. It is an extremely complicated area of tax legislation, and too often we see business owners implementing schemes that don't work. I think the general rule of thumb is that if it sounds too good to be true, it probably is. Now, we've taken top legal and tax advice on this matter, and we make sure we keep up to date with the relevant case law. So in summary, there's quite a number of benefits to be had with a properly structured employee share plan, but you've just got to make sure you get it right. If this does sound of interest to you, if you think this might apply, please feel free to contact us. We can discuss your situation in a bit more detail. Carl, do you have some takeaways?
Yeah, so we've got some key takeaways now to run through, some tangible actions you can take away and look at and put in place. So first key takeaway I've got here: when employees' cars come up for renewal, look carefully at the tax efficient options, look at the benefit in kind on the different options, make sure you're aware, make sure the employee's aware of the different impacts on their net pay of different car options, and look at what you can do to try and go for the most tax efficient option that decreases the benefit in kind for the employee and positively increases their net pay. Secondly, have a look at salary sacrifice. Look and see if there's any opportunities for you to offer support on childcare, pension contributions, low emission vehicles via the salary sacrifice scheme. Use the trivial benefits provision, as we said. It's a small provision, but it is useful, it is powerful. So that's the £50 gift. Refer to the article on staff suggestion scheme and long service awards. We'll make sure this link is on the follow-up email. And finally, if you've got key employees that we need to retain and reward, reach out and discuss a robust employee share plan. So they were the key takeaways from what we've talked about. But just before we move on to the questions and answers, we just wanted to mention something that we're finding is affecting a lot of clients right now, very much related to the inflation side of things. As we've touched on, inflation has increased significantly, and we've seen somewhat of a volatile period over the past 6 to 12 months in terms of pricing. Businesses have seen supplier price increases happening all over the place, and as a result, they've had to put sales prices up. And this has all had a significant impact on businesses' key numbers. And it's actually made it really hard for business owners and sometimes for us as accountants to actually really know how much a business is really growing and how well it's actually doing. Because your top line sales growth could be 25%, could be 30%, but how much of that is actually driven by price increases? How much of it's driven by that kind of wave of inflation and price increases, or how much of it's actually real growth in your business? Because there's not much point thinking everything's going really well because top line sales seem to be increasing massively. It could all be driven by price increases, and your volume could actually be dropping, and core business could be slipping away without really realizing it because it could be masked by price increases. So it's really critical to know what's actually happening, to actually dig in behind the numbers so you can actually understand what's happening. You can focus action in the right areas. It was just that we developed a new reporting process that we've rolled out to most of our clients, which tells us exactly what's happening in the business. We can isolate how much sales growth is actually impacted by price increases and how much your volumes have changed. And we can identify exactly how much supplier price increases have impacted your costs. And then we can look at whether you've put your sales prices up enough to maintain your margins. And we can drill into that by product for your top 20 products. You can see how much cost prices have increased, see how much you've put your sales prices up on those, see if there's still margin that you're missing out on. As we've just thought it'd be good to look at two examples, two clients that we actually did this for the other day. Before we did any analysis, they both thought they were doing pretty well, showing decent sales growth, thought everything was going fine. One of them was showing 19% sales growth. The other was showing 27% sales growth on last year. Seemed to be going fine. But we did just lift the bonnet and drilled into actually what was driving these numbers to see what was actually going on. And the results were actually quite surprising. So in the first example there, what we actually found was that on average, sales prices have gone up by 20%. So the sales growth was impacted by sales price increases by 20%. And actually, their volumes had gone down by 1%. So that was quite a surprise that actually, while the overall sales figure looked great, we were growing by 19%. It's actually all down to price increases, and in fact, volume had actually decreased slightly. And another example here, which was slightly different, we were showing 27% sales growth, quite impressive. And when we looked into it, actually, that was only impacted by sales price increases by 3%. So they'd put their prices up 3% on average. And the rest of it was coming from quite a significant increase in volume. So after we'd done that analysis, but both of these businesses realized that actually they needed to take some serious action. The actions were quite different for each. So obviously the first one had to look hard at where volumes were dropping and had to come up with a renewed focus sales plan to actually increase sales volume. They didn't actually realize that volume was decreasing. Effectively, sales were actually going down. And then the second one, they actually realized they weren't putting their sales prices up enough and not quick enough. And so they had to have a serious focus on price increases. It just really helps to sort of highlight what's actually going on and where we need to focus action. So we just thought we should mention that. And if anyone's interested in a discussion about running that for their business, there'll be a link in the follow-up email to schedule a call to discuss that with you. So moving on to questions and answers. So we've had a flurry of questions coming in, which is good. Let's just have a look at these. So first question here, how can I check an employee is on the right tax code? It's an interesting one and quite a common one. It's surprising how many times tax codes are wrong without anyone realizing it. Well, the thing to do is have a look at what the tax code is and have a look at how it's calculated. You need to have a look at the coding notice that HMRC have provided. If you need to, you might actually have to ring HMRC to say, ask them where they've got some of their figures from. And then you need to just challenge that against what is actually happening. Another question here. So what interest rate could be charged by an employee above the base rate? That's an interesting one. It's not actually a very easy one to answer just like that. It would really be down to what you can agree between the employee and the employer, but you just got to look at comparable loans. So if you've got an unsecured loan from someone else, from another external provider of finance, what kind of interest rate would that be? An unsecured loan. And if you've got something comparative like that, then you can base it on that. Don't know if you'd have any other comments on that, Jack.
Yeah, fully agree. You've just got to make sure that you could justify that percentage compared to other unsecured loans.
Yeah. Another question here, what's the maximum frequency for trivial benefits, Jack? Any thoughts on that one?
Well, there isn't really. In simple terms, there isn't a maximum. However, you've got to be careful that it doesn't become regular and then seen as part of their package. I think we did discuss. We would recommend really that £300 per limit per director. Apply the same principle to the employees. I think Carl, you might have more comments, but £300 really shows us what HMRC are expecting, doesn't it?
Yeah, that's right. Yeah. So there's not strictly a limit to the number of times you can do it for employees, but there is this £300 per annum limit for directors, which is worth using, by the way, for directors. But there is that £300 per tax year limit for directors. And I think that gives an indication really as to what HMRC would expect for normal employees as well as a safe maximum. There's another question here about very similar, linking to trivial benefits. When you say £50 can't be given tax-free for performance, if everyone gets the same because the company has achieved a target, what's the score? Well, in that case, it's related to performance. That's the thing. If you're giving it because it's related to hitting a target, you're making it performance related, and that's means you're not going to fit in with the rules for trivial benefits. So it's got to be a genuine gift. It's got to be for another reason. It's got to be because it's someone's birthday or anniversary or something like that. So another question here. And can you enlarge on using an established scheme in connection with salary sacrifice? Was this in relation to vehicles? Jack, have you got any thoughts on that one?
Yeah, that's correct. So there are providers out there that will, you might say, manage the whole process. They'll sort the vehicle out for you. They will take care of making sure all the legals are correctly in place. They'll sort out the contracts, make sure the maintenance is sorted for you. So just recommend going somewhere like that, because there are a few pitfalls in terms of even the timing of when you change the contract and when they get the vehicle, when they stop paying, when they start reducing the salary. So you've just got to be careful and make sure we're using someone who, might say, knows what they're doing. I don't think it's one of those things where you can just do it yourself.
Thanks, Jack. On the same kind of vein, how is the salary sacrifice for an electric vehicle different to a simple company vehicle? And who covers insurance? So it's just make sure we've got that question clear. So how is a salary sacrifice for an electric vehicle different to having a normal company vehicle? So I think the point is that it's different. It's different cattle officials together, really. So Jack mentioned previously that in the example that the employee was wanting a certain car, and actually the employer wasn't prepared to foot the bill for that car. They weren't actually wanting to pay for a company car for that particular employee. And it's in that kind of situation that salary sacrifice works quite well, because the employer pays the lease payments, pays the contract hire, whatever it is for the car, and the employee sacrifices the same amount of salary. And so what that means is the employer hasn't lost out at all. They haven't borne any costs for that car, but it's more cost effective for the employee because they've sacrificed some of their salary. They actually save the 40% tax and the employee's NI 3.25% on that. So there is just a bit of a saving for the employee over and against them just going out and buying a car privately. So hopefully that makes some sense. Don't know if you've got anything to add to that, Jack.
No, that's correct. Yeah, at the end of the salary sacrifice, I would say, is more for where they're either not provided with their own car as part of their package, or an employee is perhaps looking for a second car or something like that.
Yeah. Another question here. Can an employee be made a non-executive director and paid dividends, i.e. they are board members but not shareholding directors? An efficient way of sharing profit but not gaining ownership. You'll definitely have some comments on this, Jack, but to be able to pay dividends to somebody, they've got to be a shareholder. Dividends are paid on shares, so they have to be a shareholder. I don't know if you've got any other comments on that question, Jack.
Yeah, it's good. Yeah, and so further to that, you've got to make sure that they are proper shareholders, as in when we say proper shareholders, we're talking about they have a capital ownership. It doesn't work to just make them dividend only shareholders, as some will be aware of the expression, where they don't have any rights to the capital of the company. At the end of the day, that is just diverting their income, and if it was inspected, I would expect them to be taxed on it as employment income rather than dividends.
But basically, there are ways to make employee shareholdings work, and it really warrants a proper discussion about your situation and a bit more detail to actually assess the situation, look at who the employees are and what's their situation, and build something that will work. Good. There's lots of questions. Is the maximum gift for an employee £50 per annum? I think this is taking us back to trivial benefits. No, it's not £50 per annum, it's £50 per gift. Another question, any idea what will happen to the 2% bet in kind for electric vehicles after 2025? Have you got any ideas on that, Jack?
It's difficult to say. Obviously, with the increase in electric vehicles, I wouldn't be surprised if it went up. However, I would be surprised if it jumped up significantly. I think if you look over the last few years, it's gone from 0% sort of gradually to 1% and 2%. So I wouldn't be surprised if we see a gradual increase, but I don't think we're going to see it jump up to 15%.
Good.
But no one knows.
No, exactly. It's a bit of an unknown. Good. Well, I think that's probably most of the questions covered there. Good. Thanks very much, everyone, for joining us. It's been really good to have you on board. Hopefully, you've got some value out of today's session that you can take away. Thank you very much, and look forward to seeing you on next month's event. Thank you.